A mixed signal from the labor market this morning. New unemployment claims rose 225,000 last week, the highest level in 4 months and above economists' expectations. At the same time, continuing claims moved lower, suggesting the job market remains relatively stable despite some signs of slowing. Joining us now is Anthony Saccaro, president of Providence Financial and Insurance Services. Anthony, good to have you. So we just saw jobless claims rise, 4-month high, but the unemployment rate remains relatively healthy, 4.3%. What's your read on the latest labor market data?
Well, the labor market ultimately is in a really good position. If you go back a couple of years, there were so many more jobs than there were workers. Workers could kind of write their own check. And it wasn't horrible, but it had to come back down. And there's been a lot of wage inflation. That's a part of why we have inflation the way that it is. But it's softened now to where there's about a 1-to-1 ratio, just slightly few more workers than there are jobs than there are workers available. So it's very normal at this point. There's nothing to panic about at all. It was higher than expected. We're in a situation that a lot of economists are describing as low fire, low hire. Like a lot of companies aren't doing a lot of hiring. Employees don't want to quit and go to another place. They feel like they're going to have a hard time finding a job. And companies are also not letting people go. So it's not a bad position to be in. And it's certainly not what the Fed's focused on.
Right. And many Americans aren't really worried about the economic reports. They're worried about keeping their jobs and affording life. So based on what you're seeing, if someone loses their job today, is it taking longer to find a new one than it did, say, a year ago?
It definitely is. It's harder to find a job today as well. And what that does is it means that workers want to stay employed a little bit longer. And that's why they're not quitting. Because they're not quitting, companies are not necessarily going on this hiring spree. If anything, it might be going the opposite direction because of the AI craze and everything else. But the fact is that in this environment, everything is pretty stable. So if you're going to quit your job, you probably should have something lined up ahead of time. And because we are a consumption-based economy, 70% of GDP in the United States of America comes from consumers. As long as consumers continue to have jobs, as long as that unemployment rate stays at 4.3%, which is a really low, very acceptable unemployment rate, then we can continue to see the economy humming. The economy is going to be tied to the labor market. Whatever happens to the labor market is going to determine where the economy goes. And if the labor market starts to soften more, to me, that's the number one indicator as to what would be the leading indicator of maybe the stock market.
Okay, so now all eyes are on tomorrow's jobs report, right? So if it comes in stronger than expected, that's good, right, on one hand, but then does that make the Fed less likely to cut interest rates, which we all need in the near future?
Well, do we need it? I mean, who needs it, I guess, would be the question, right? The fact is that, yes, the strong jobs report tomorrow would be great, but the Federal Reserve is in this pickle. The Federal Reserve is in a situation where they've got the dual mandates. They've got the fight inflation, right? And they've got full employment. Well, those two things are pulling against each other right now. You've got the labor market that's softening, and a softening labor market bids for them to want to cut rates. But then you've got inflation growing. It's increasing, especially when you look at the disturbing PPI report that just came out in April. That's a leading indicator that tells us that we could have a larger inflation than expected on the horizon. And that is now causing the Federal Reserve not to want to cut rates and maybe even raise rates. So they're in this battle where inflation says, hey, you might need to not only not cut, but raise. And then you've got the labor situation where it says, hey, you might need to cut. And it's the inflation that they're more focused on. That's what's going to get their attention as long as the labor market stays the same. So they are having this battle. Right now, it's projected that there's going to be one 25 basis point cut this year, and I think another one for next year. I think it's way too early to call next year, and possibly even this year. I wouldn't be surprised to see if not only do they not cut this year, though, but if they either leave the same or even have to raise, that's going to be tied to what happens with inflation. When inflation continues to grow, they're not going to be able to cut it all.
Right.
They're going to have to raise.
Yeah, I mean, that's going to hurt people with record high credit card debt, savings accounts being drained. It's also going to hurt people hoping to buy a home, for the first time. So we'll wait and see. Anthony Saccaro, president of Providence Financial and Insurance Services, thank you so much for your insight today, as always.
Thank you, Alicia.
You got it.